Hey everyone, Tom here. Welcome to the room. What's a leap option? It's basically something that stands for long-term equity anticipation. It's basically an option that has greater than 9 months to expiration. So if you were looking at leap options as of today, you need to go out to around December of this year or January of 2026. We're going to take the information from what I just talked about, and we're going to apply leap options to it for bullish strategies. Now, if you remember, we're taking what's called an 85-5 rule. 85% of the time, when the markets drop 5% or more, 6 months later, they are at higher highs to a tune of 8%. We're going to use all of that and build a couple of different leap option strategies around that. So first, take a look at the chart of the S&P 500. As you can see here, we've had a nice long move off the bottom. This is a weekly chart, but look at all the gains that got eroded from really just the last 4 weeks. And you can see a bit of a bottoming out there. So if we were to take the 85-5 rule and apply it to where we are right now, that puts us up around 615, which is 8% higher than we are right now, off of the S&P 500. Perfect. So spot the opportunity. Next thing I'm going to look at doing is creating an alternative risk trade, because we could buy the S&P right here, but we're talking about $56,455 for 100 shares. I think we can do better. Now, by looking at options, the call options, the 565 calls, they cost about they're priced at 43.51. You got to move the decimal place over to the right 2 times, and that's what it's going to cost you per contract, $4,351. All right, great. Still a lot cheaper than 56,000, but still rather expensive. And it gets worse on buying these long-term calls. If we are looking at 615 as a target price, well, look at the break even on this. You take the strike price, which is going to be those 565 calls, strike plus premium. That gives us a break even of 608.51. If I believe the target on this is 615 by the time we get into the end of the year, that's not much greater than the break even of 608. So the reward risk ratio, in my mind, just doesn't work. What else can we do? Well, we can go back to our faithful friend, call spreads. Call spreads are when you buy a lower strike call and then you finance it by selling a higher strike call. So buy a lower strike, sell a higher strike, and you can do that across the same expiration, all right? And of course, the same symbol. We can push that all the way out to buying leap spreads. All right, a leap spread is just a long-term call spread. So buying the January 16th, 2026, all right, we buy those 595 calls and we sell the 615. The 615 is our target. What do we pay for when we do this trade? Right now, as I can see, it's looking like it's going to cost around $9.24. That's $924 for the spread. 2 things kind of pop up right here. Number one, it's a lot cheaper, okay? And then number 2, the break even is a lot better. And number 3, if we get to 615, that strategy will double in value. So in summary, the strategy itself involves buying into a downtrend. That's not something that a lot of people can stomach. Options will help. Leap options, well, they're not cheap. They're going to cost you a lot of money to get into because you're buying the most time premium that's available out there. So leap spreads, if you look for an idea of a target price and a target time, are going to dramatically reduce the time risk, as I've shown right here. All right. Thank you very much. Like, share, and subscribe. I'll see you on the next one.